I think, okay. So good afternoon, everyone. I'm Lisa Donner, and I'm the Executive Director of Americans for Financial Reform. I want to welcome you and thank you all for coming on behalf of Americans for Financial Reform and also the Economic Policy Institute and the Roosevelt Institute, with whom we are jointly sponsoring today's. I'm going to very quickly say something about what we hope to do this afternoon, and then also very quickly introduce Senator Warren so we can spend as much time as possible actually listening to the Senator before she needs to go. Especially after the recent Stronger Jobs report, next week's meeting of the Federal Open Market Committee will be the occasion for a bunch of argument about whether the Fed should increase short-term interest rates in order to head off inflation and prevent excessive speculation and risk-taking in the world of finance. But raising interest rates is likely to hurt job growth and throw a damper on economic recovery, which is already coming very slowly, if at all, for too many people who are hit hard by the financial crisis and its aftermath. What if there are alternative ways to approach dealing with bubbles and other speculative dangers, with regulatory tools that are more targeted to specific risks? And what if using financial regulation effectively could also help allow the Fed to stimulate the economy in ways that deliver more benefits to working people and are less likely to further overweight the financial sector? These are hardly radical questions. Fed Chair Janet Yellen has talked about the importance of macroprudential regulatory tools to deal with financial stability and the work that the Fed is doing to put these in place. But we think they're very important questions and that they need more attention, and we want to dig in further. For many of us, too, putting these pieces together is part of our continuing focus on deepening our understanding and the public's recognition of the fundamentally important relationships between the financial system, financial regulation, and how the real economy works or fails to work for everyday Americans. So our first panel, immediately after Senator Warren speaks, will focus on the downsides of relying only on monetary policy as a tool for stabilization, as well as on the debate about the extent to which the Fed should pull back its support for economic recovery in order to keep inflationary pressure in check. Then there'll be a second keynote from Paul Krugman, and then the second panel will examine the financial regulatory tools available and consider how and to what extent they can in fact be used to control financial risks. Now for Senator Warren. We're very fortunate to have the Senator with us today, and even more fortunate to have her in the Senate every day and enjoy her leadership standing up to the excessive economic power and political influence of Wall Street, in spelling out the harm that does to families and communities, and in insisting that things need to be and can be different, and that legislators and regulators can make different choices to get us there. We've been lucky enough to work with the Senator on the creation of the new Consumer Financial Protection Bureau, a remarkable example of the difference that approach can make, and are so glad to be able to continue the conversation about advancing these important principles. Senator Warren.
Thank you. Thank you. Thank you for the kind introduction. Thank you for this chance to be able to join all of you here today. Today's event focuses on how the Federal Reserve can use its monetary tools to promote economic growth and its regulatory and supervisory tools to rein in our financial system. You know, the Fed has always had dual responsibilities: monetary policy and regulatory and supervisory policy. But in the wake of the 2008 financial crisis, Congress gave the Fed even more regulatory and supervisory authority than it had before. The new chair of the Fed, Janet Yellen, recently acknowledged the board's supervisory responsibilities are just as important as its better-known obligation to set interest rates and conduct monetary policy. I think the lapses that led to the 2008 crisis drove that point home with searing intensity. The Fed is now our first line of defense against another crisis, and we've made progress through the Dodd-Frank Act. Even so, the risk of another crisis remains unacceptably high. Take just one example. This summer, the Fed and the FDIC determined that 11 of the country's biggest banks had no credible plan for being resolved in bankruptcy. Now, that means that if any one of them takes on too much risk and starts to fail, the taxpayers would have to bail it out to prevent another crash. We're all relying on the Fed to stop that from happening, which means we're all relying on the Fed to get tough in regulating the biggest banks. The question is whether the bank regulators can do the job we need them to do. And that raises an issue about the influence of Wall Street on financial regulation and economic policy. It's an issue that affects not only the Fed, but also the other banking regulators, the Treasury Department, and our government's entire economic policy-making structure. So let's look at some facts. Fact one, Wall Street spends a lot of time and money influencing Congress. Public Citizen and the Center for Responsive Politics found that in the run-up to Dodd-Frank, the financial services sector employed 1,447 former employees to carry out their lobbying efforts, including 73 former members of Congress. And according to a report by the Institute for America's Future, by 2010, the 6 biggest banks and their trade associations employed 243 lobbyists who once worked in the federal government, including 33 who had been chiefs of staff and for members of Congress, and 54 who had worked as staffers for the banking oversight committees in the Senate and the House. Now, that's a lot of former government employees and congressmen pounding on Congress to make sure that the big banks get heard. No surprise that the financial industry spent more than $1 million a day lobbying Congress on financial reform, and a lot of that money went to former elected officials and government employees. Fact two, Wall Street dedicates enormous amounts of time and money to influencing regulatory policies. The Sunlight Foundation, a nonpartisan, nonprofit organization, took a look at all of the meeting logs from 2010 to 2012 of the Treasury Department, the Commodities Futures Trading Commission, and the Fed. It found that those 3 agencies reported meeting with one of the 20 big banks or banking associations a combined 12.5 times a week. That's about 5 times as often as reform-oriented groups combined. That works out to nearly 1,300 meetings over 2 years. Goldman and J.P. Morgan each met with those agencies at least 175 times, or nearly twice per week, every week on average. And keep in mind, that's the count at only 3 of the 7 major regulators. Fact 3, Democratic administrations have filled an enormous number of senior economic policy positions with people who have close ties to Wall Street. Starting with Robert Rubin, a former Citigroup CEO, 3 of the last 4 Treasury secretaries under Democratic presidents have had Citigroup affiliations before or after their Treasury service. The 4th was offered, but declined, Citigroup's CEO position. The new vice chairman of the Federal Reserve, Stanley Fischer, was a Citigroup executive. Directors of the National Economic Council, the Office of Management and Budget, our current U.S. Trade Representative, and senior officials at the Treasury Department have also had Citigroup ties. Now, that's the record for just one single bank. Many other senior officials in recent administrations have had ties to Goldman, J.P. Morgan, Bank of America, Morgan Stanley, or other major Wall Street firms. Still more officials, including 2 recent appointees to the Commodity Futures Trading Commission, were lawyers who spent huge portions of their careers representing Wall Street institutions. This is the revolving door at its most dangerous. In virtually every economic policy discussion held in Washington, the point of view of Wall Street banks is well represented. So well represented, in fact, that it often crowds out other points of view. And that's the context for thinking about the nomination of Antonio Weiss. He spent the last 20 years at the investment bank Lazard, and he's been named to be Undersecretary for Domestic Finance at the Treasury Department. He is focused on international corporate mergers, companies buying and selling each other. Now, it may be interesting, challenging work, but it does not sufficiently qualify him to oversee consumer protection and domestic regulatory functions at the Treasury Department. In addition to his lack of basic qualifications, Mr. Weiss was part of the Burger King inversion deal that moved the U.S. company to Canada as part of a merger that would cut down on its tax obligations. Also note that Mr. Weiss's friends at Lazard are giving him a golden parachute valued at about $20 million as he goes into government service. For me, this is just one spin of the revolving door too many. Enough is enough. The response to these concerns has been, let's say, loud. First, his supporters say, come on, and he's an investment banker, so of course he should be qualified to oversee complicated financial work at Treasury. But his defenders haven't shown that his actual experience qualifies him for this job at Treasury. Professor Adam Levitin, a law professor who teaches financial regulation at Georgetown, wrote a really good piece about this last week. He looked at each of the functions of the undersecretary position and, as he put it, quote, almost none of that relates to the work of an investment banker doing international M&A. Professor Simon Johnson, the former chief economist at the IMF, who now teaches at MIT, agrees. He noted last week that this position is, quote, the third most senior official in the executive branch with regard to fiscal decision-making. And then he goes on to say, it's hard to think of any senior fiscal official from a serious country with qualifications as weak as those of Mr. Weiss, end quote. Professor Levitin and Professor Johnson are right. I worked at Treasury, and I know how critical this position is to financial regulation issues. Despite what some of Weiss's supporters have said, the job isn't just to peddle U.S. Treasuries to foreign investors. And even if it were, Weiss is a corporate deal maker, not a bond trader. Professor Levitin makes another good point about this. Quoting Professor Levitin again, the shock of Mr. Weiss's supporters that anyone would dare question his suitability reflects an unspoken assumption that anyone from Wall Street is, of course, expert in all things financial. That's hooey, end quote. I agree. We'd all scratch our heads if the president nominated a theoretical physicist to be the Surgeon General just because she had a background in science. It's no less puzzling for the president to nominate an international mergers specialist to handle largely domestic economic issues at Treasury because he has a background in finance. Second, Weiss supporters say that Burger King isn't a classic inversion deal. Okay, so when Burger King moved to Canada in a deal that would lower its taxes, I guess it was an unclassic inversion deal. Got it. But let's be clear. In August and September of this year, more than 2,600 news stories mentioned Burger King in the context of tax inversions. There has been some debate over the details. People disagree about what the exact implications will be for Burger King and whether their taxes will go down a little or go down a lot. But no matter how many Burger King executives line up in the newspapers to say that they had other motives, this is an inversion deal, and Mr. Weiss was right in the middle of it. Now, this matters Because at the end of the day, the administration undercuts its own opposition to this practice by nominating someone to a high-profile who was involved in a high-profile cross-border inversion, and who, by the way, made $15 million in the last 2 years working for Lazard, a firm that did 3 of the 4 major announced inversions. And by the way, Lazard isn't an American company anymore either. It already moved to Bermuda to cut its taxes. Third, and maybe you can help me understand this argument, people say opposition to Mr. Weiss is unreasonable because, wait for it, he likes poetry. I'm actually not kidding on this one. Supposedly, because he helps publish a literary magazine called the Paris Review, we should trust that he will zealously pursue financial reform. Now, I confess, I don't read many literary magazines, but really? If he liked monster truck racing, would that show that he supported Wall Street bailouts? I don't get what his hobby has to do with overseeing consumer protection and domestic regulatory functions at the Treasury Department. So what is this really all about? Why call out the cavalry for a guy whose experience doesn't match the job he's been nominated on? Why circle the wagons around a guy who's picking up $20 million to take on a public service job? It's all about the revolving door, that well-oiled mechanism that sends Wall Street executives to make policies in the government and sends government policymakers straight back to Wall Street. Weiss defenders are all in, loudly defending the revolving door and telling America how lucky we are that Wall Street is willing to run the economy and the government. In fact, Weiss supporters even defend the golden parachutes like the $20 million payment that Weiss will receive from Lazard to take this government job. Why? They say it is an important tool in making sure that Wall Street executives will continue to be willing to run government policymaking. Now, if that sounds ridiculous to you, you are not alone. Sheila Bair, a Republican and the former head of the FDIC, responded that, quote, only in the wonderland of Wall Street logic could one argue that this looks like anything other than a bribe, end quote. She went on, we want people entering public service because they want to serve the public. Frankly, if they need a $20 million incentive, I'd rather they stay away. Why does the revolving door matter? Well, because it means that too much of the time, the wind just blows from the same direction. Time after time in government, the Wall Street view prevails, and time after time, conflicting views are crowded out. Consider the deregulation of the banking industry in the 1980s and 90s, followed by the no-strings-attached bank bailouts in the aftermath of the 2008 financial crisis, and most recently, the anemic efforts to help homeowners who had been systematically cheated by financial giants. The wind always blows in the same direction. The impact of the revolving door can sometimes be subtle. No one likes to ignore phone calls from former colleagues, and no one likes to advance policies that could hurt future employers. Relationships matter, and anyone who doubts that Wall Street's outsized influence in Washington has watered down our government's approach toward still too big to fail banks has their eyes deliberately closed. Take one example. Brown-Kaufman was a proposed amendment to the Dodd-Frank Act that would have broken up the nation's largest financial institutions. That amendment might have passed, but it ran into powerful opposition from an alliance between Wall Streeters in government and Wall Streeters still on Wall Street. The hand-in-hand between Treasury officials and Wall Street executives on this was not subtle. A senior Treasury official publicly acknowledged it at the time. The revolving door rips the heart out of public service. Too many people get jobs based on who they know, not what they know. Too many others who might have brought a different perspective to this work get crowded out. I know that there are experienced and innovative people in the financial industry who are qualified for top economic positions in government. Look, when I set up the new Consumer Financial Protection Bureau, I interviewed, I hired, and I worked alongside many people with Wall Street experience, and I was glad to do so. In the Senate, I have voted for plenty of nominees with Wall Street experience, but we need a balance. Not every person who swoops in through the revolving door should be offered a top job without some serious cross-examination. Qualifications matter, and Weiss doesn't have them. This is about building counter-pressure on the Wall Street bankers. Members of Congress, their staffs, and the regulatory agencies are going to hear the Wall Street perspective loud and clear each and every minute of each and every day. That isn't going to change. But we need a real mix of people in the room when decisions are made. When the president has an opportunity to decide who will be at the financial decision-making table, he should think about who knows the economics of job creation, about community banks and access to financing for small business, about who has the skills and determination to make sure that the biggest banks can't take down our economy again. The titans of Wall Street have succeeded in pushing government policies that made mega banks rich beyond imagination, while leaving working families to struggle from payday to payday. So long as the revolving door keeps spinning, government policies will continue to favor Wall Street over Main Street. I hope you will join me in saying, enough is enough. Thank you.